Walk through any local market this week, and you'll feel the sudden, jarring halt of consumer purchasing power as household budgets are squeezed. After 13 months of steady prices, Amul and Mother Dairy have both hiked the cost of milk by 2 rupees per liter. Simultaneously, the government has imposed a total ban on sugar exports through September, a complete reversal of the pro-export stance they held just months ago. These localized price spikes and export bans are the first tremors of a massive, invisible global threat hitting the Indian middle class. To stop wealth from leaving the country, the government has raised the import duty on gold and silver to 15%. This intervention is a response to a bleeding currency. The rupee has hit a record low of 95.76 against the US dollar, inching ever closer to the triple-digit mark. The Prime Minister has taken the unusual step of urging citizens to stop buying gold for a full year to protect national interest. Between aggressive taxation and export lockdowns, India is now in a defensive crouch, attempting to shield the rupee from a mounting external crisis. This domestic financial strain is being dictated by a military escalation thousands of miles away between the United States and Iran. The conflict has effectively blockaded the Strait of Hormuz, the primary artery for the world's energy supply. Drone attacks are now actively targeting commercial cargo ships, including an Indian vessel recently struck near the coast of Oman. As shipping lanes freeze, the price of crude oil is being pushed toward $150 per barrel, threatening a global energy shock. While wars in Europe disrupted specific markets, this conflict has the unique capacity to freeze global energy transit entirely due to this single geographic choke point. For an import-dependent nation like India, the forces controlling this narrow waterway now dictate the price of daily survival. This pressure travels through wholesale inflation. The rising costs of raw steel and industrial logistics factories must pay before product reaches a shelf. Driven by the imported oil shock, India's wholesale inflation has spiked to 8.3%, the highest level in 3.5 years. This creates an expanding trade deficit, where soaring oil import costs far outweigh the revenue India generates from exports. From a burning ship in the Gulf to a widening national deficit, the final cost of this global disruption is handed to the consumer at the grocery counter. This multi-front pressure is pushing the Indian economy into a critical stress test. The ratings agency S&P Global recently evaluated how the country's financial structures are holding up under these conditions. Their assessment suggests that India's massive foreign exchange reserves act as a buffer, allowing the economy to absorb the initial volatility of the oil shock. While the national treasury has the reserves to prevent a total collapse, the burden of enduring this inflationary period now rests on the choices of individual citizens. Surviving this period requires a coordinated reduction in national demand, specifically cutting back on fuel and non-essential imports. Behavioral shifts like utilizing public transit and adopting work-from-home models are becoming essential tools to lower the country's collective energy bill. If the economy can withstand this level of global instability without breaking, it sends a powerful signal of stability to international investors. For the middle class, this is a brutal endurance test. But successfully navigating this crisis is the only way to prove that India can maintain its growth even when the global energy market is in chaos.